Hey guys, as most of you know, my name is Derek Rodriguez. I'm a loan officer over at Cardinal Financial. I'll talk about a little bit about the company, the market, purchases, refinances, conventional loans versus FHA loans. So we'll get into that. Cardinal Financial, we're a direct lending mortgage bank founded in 1987. We're actually owned and backed by a very large hedge fund called Fortress, which means we have a lot of backing in regards to money. We're very lenient as far as, writing loans. We're not as strict as the Chases, the Bank of America's, all those really don't need to lend to risky loans. We're actually licensed in all 50 states. My branch is located in Melville. We opened up this branch about 2 years ago. Our corporate is in North Carolina, so we're actually a very large company. We're very known down south. We're kind of building the brand up here on the Northeast. As a lender, we actually do about $1 billion a month in business. So it's, we're getting there. We're labeled as a top 15 lender in the country at this point. So now with the market, as you guys probably know, the market right now between refinances, purchases are very, very hot, really low. A lot of my clients are getting anywhere between the low 3% range up until, up to like the mid twos. So, which is helping in regards to purchases. Lower interest rates are going to help you qualify for more when you're purchasing a property. If you're getting a rate in the, mid to high 2% range, that's saving you $300 a month in regards to your monthly payment. It's going to help you qualify for more, when you're looking to buy a house. Now with the refinances, obviously, lower rates are going to save you money on interest. It's going to give you an opportunity to, just do a regular rate and term refinance and lower your interest rate, which is going to save you in the long run. And if you wanted to pull some cash out, money's cheap right now. So you could take that money at low interest and, whether you want to do home improvements or, invest, you have that opportunity. Now purchases right now, obviously the market, like I said, is very hot. You have a lot of people, and Linda can attest to this. You have a lot of people that are leaving the city and coming out here, being, what's going on with the pandemic. So inventory is very low. So I actually, for example, I have a client that just put an offer in on a property, $50,000 over asking price, and I still don't have an accepted offer, which is crazy if you really think about that. In a normal market, most people are going to jump on that right away. But I deal with a lot of first-time home buyers. Now, a lot of these first-time home buyers are a little nervous. Obviously, it's the biggest investment of their life. And a lot of them don't know the process, and they need to be, walk through the process and have their hand held, which is perfect, So the first step of purchasing a home is getting pre-approved. Getting pre-approved is extremely important because you have an idea of exactly what you can qualify for. That way, when you start looking at homes, you're looking in the right area. You have some people that don't want to, get pre-approved. And, I can afford $500,000 on a home, and they look. Let's say they do get an accepted offer without a pre-approval, which is very rare. And you come back and you're only pre-approved up to $450. Okay. Now you wasted your time. You did the realtor's time at these homes for you. And it's just a big waste of time. Why not get pre-approved? It's a free quote, and you know exactly what you qualified up to. That way, when you start looking at homes, you're looking in the right area. It's a benefit for you. It's a benefit for the realtor. It's a benefit for everybody. I've also talked about briefly a program that we use that I don't really think, I haven't seen any bank use this program at all, which is called the TBD Pre-Plus. We're actually able to send our files to an actual underwriter prior to you even finding a home. So basically what that means is, I have a client, I, take a mortgage application on them, I get their income documents, I send the file to an actual underwriter, not just, AUS, which is our automated underwriting system, which every lender is going to use. I actually am able to send the file to an actual underwriter. The underwriter will go into the file, they'll approve the pay stubs, they'll approve the W-2s, the bank statements, driver's license. So that way I actually know to a T what this borrower can afford. So you don't have to worry about any debt to income ratio issues, nothing like that. Also, what happens is when the underwriter is done pre-underwriting the file, they actually offer a letter, which is extremely not going to see any other lenders that are giving out commitment letters prior to a buyer going into contract. So what that does for my clients is it gives them the upper hand when putting in an offer on a property. So basically, if my buyer has a pre-approval letter and a commitment letter, and they offer on a property for $450, right? Let's just say, and another buyer has a pre-approval letter and puts in the same offer, basically 10 times out of 10, that seller and the seller's realtor are going to accept the offer with the commitment letter because they know that the file has been approved by an underwriter. And, basically there's not going to be any problems. It's more comfortable for a seller to see that, all right, this file was already sent to an underwriter and been approved. I've actually, you have a lot of, and this has happened recently a couple of different times, probably like 2 to 3 times in the last month or two, where I've actually spoke with the sellers, the selling agent, and I explained the process of TBD pre-approval. I can get you a commitment letter, and they absolutely love it. It makes them feel comfortable. Oh, that's amazing. I send them over the commitment letter. Right now, the turn times with the underwriters are anywhere, and this is going to be any lender, anywhere from 15 to 20 days. So other lenders are going to take 15 to 20 days to get a commitment letter, right? After going into contract. I can get it right away. I can get it before we go into contract. So, it gives my buyers the upper hand. Also, with in regards to refinances and purchases, we actually will charge no bank fees for first responders, which has been awesome. I just did a refinance for one of my cousins. He's a police officer. So we got him a very good deal in regards to, not charging him any processing, underwriting fees, no points, nothing. On a 15-year, I was able to get him a 2.5%. So he was very, very happy with that. Now we go as far as FICO scores. Okay, when purchasing a home, right? It used to be FHA was 580. We can go down to 580 where you can put down 3.5%. Right now, it's typically 620. We do 580, depending on certain debt to income ratios. So if your debt to income ratio is extremely low, but you have a 590 credit score, I could do the loan. I could write the loan. But 3.5%, 620 with normal ratios is fine right now. Chases and those bigger banks, a lot of the other banks are anywhere from 640 and up, 640, 680. At one point, Chase wasn't doing loans that you had a sub 700 FICO score with 20% down, which is crazy, in the beginning of the pandemic. Now refinances, we do, the only thing we don't do is home equity lines of credit, but we do cash out refinances. Now, a little bit with the rate and terms, we could lower your rate. We can cut the term, which is going to save you interest, obviously in this market over the life of the loan, and it's going to be short-term savings and long-term. With the rate and terms right now, when you cut your term to a 15-year, let's say, the rates are extremely low on a 15-year loan. So, you have a lot of people looking into that, being that the rates are so low. You could cut your term to a 15-year at, let's say, 2.5%, and the amount of savings that you're going to have in regards to cutting years off of your loan. Maybe your payment goes up $200 because your interest rate is so low, it's only going up $200, but you're cutting off, let's say, 10 years. So you have a lot of that. Now with a cash out refinance, I mean, money's cheap right now. So, you have a lot of people looking into pulling cash out for maybe some cash in hand, or they're taking that money and investing it, whether it's buying another house or, investing in stocks, whatever they want to do. You have that opportunity right now, being that money is so cheap. And the most common refinance is always a debt consolidation, a cash out debt consolidation loan. You have a lot of people that you look at their credit report and they're drowning in credit card debt. And credit card debt is, you're looking at 20% interest on a credit card, So what a lot of people are doing, if they have equity in the home, they're paying off this credit card debt. Okay. Now, let's say you have a borrower that has a $10,000 credit card, $8,000, $15,000 credit card, and we're paying that debt all off. Okay. Now, basically with that, your monthly payment may go up. Let's say it goes up $200, but the way you have to look at it in that sense is you're looking at the total monthly obligations, right? So, your mortgage payment may go up $200, but you're saving $600 or $650, by paying off all this high interest credit cards, or these high interest credit cards. You're taking the high interest credit cards and you're bringing it down to, low 3%, maybe sub 3%, 2.75, 2.625, which is saving you a ton of money, in interest. Now, another thing is costs. A lot of people, when they refinance, are weary about costs. Their loan balance is going up. As a lender, we charge about $1,600. Okay. Now you're going to have to pay your fees, your statements, tax for FHA loans, your upfront mortgage insurance, your title fees, your attorney fees. All that goes into it. Okay. But what people don't realize is there's no prepayment penalty. Okay. So when you refinance, let's say we were to close your loan in October, right? You wouldn't have to make your October payment. You wouldn't have to make your November payment. Your first payment will be due in December in that case. So let's say your mortgage payment is $2,500, right? So you're going to get 2 months off of the mortgage. Times that by 2, obviously, is $5,000. Now, also, one of the biggest in regards to closing costs is your escrow payments. Okay. Obviously in New York, it's very high. Taxes are extremely high. So what you're going to get is in regards to your escrow money, that's your money, right? The lender holds that for you to pay your taxes and insurance. Okay. So let's say you're getting 2 months off of the mortgage at $2,500, that's $5,000 a month. And you have $6,000 in your escrow account, right? We're going to be setting up a new escrow account with you, okay? Which means your current lender, let's say your lender is Chase. In your escrow account, there's $6,000. When we pay off that loan, they will cut you a check for $6,000. So that's basically a wash in regards to the cost. So let's say you got $6,000 back plus the $5,000, that's $11,000. Being that there's no prepayment penalty, you could take that money if you'd like and put it right back into the loan, right towards principal, to bring that balance right down. A lot of people, don't really do that, is because they have a chance to now not make their mortgage payment. They could save that money, they get their escrow money back, and they could do what they want with it, whether it's whatever they want to do. They can put that money in their savings. They could they may need to spend it on doing some home improvements. It's up to them, which is always good. Now, I want to get into a little bit of conventional versus FHA loans, right? I work with a lot of first-time home buyers, which a lot of them like to go FHA with their loans. And the reason is because of the minimum down payment. With an FHA loan, you can put down 3.5%, which is feasible for a lot of first-time home buyers. Conventional is typically 5%. Now, you can put 3% down. There are programs for conventional income limit. So, the income limit here is like $72,400 for conventional home ready and home possible programs, which is the 3% down. So, some people may not qualify for that. And you also have to have a very good credit score, for those loans. Now, FHA, like I said, a lot of people like to use the FHA loans because they're more risky loans. So we can, like I said, earlier, we go down to the 580 with those. And there's more room in regards to what you can qualify for. FHA loan can go up to 57% back end ratio, where conventional loan goes up to 49. So, the FHA loans are classified as more risky loans. They're government loans. So base FHA loans, you're always going to pay mortgage insurance. Okay. It doesn't matter what kind of loan to value ratio you have, you'll always be paying mortgage insurance. They're deemed as riskier loans. And, so that mortgage insurance is going into a pot, because FHA, the way they look at it is FHA borrowers are more likely to default. They're lower credit score, lower income borrowers. So you're always going to pay that mortgage insurance. Now with conventional loan, you're going to pay mortgage insurance, private mortgage insurance, but you have the opportunity to, on a refinance, you could buy that out, or, when you put 20% down on a home, you won't pay mortgage insurance. Once you receive, so let's just say you were to put 10% down on conventional loan, and in a year you have, 20% equity in the home, the mortgage insurance will automatically fall off. In an FHA loan, you could have a 50% loan to value ratio, you're still paying mortgage insurance. Conventional, that's not the case. You won't be paying mortgage insurance. So, you get higher credit score borrowers with higher income, like the conventional loans, because it's going to save them in the long run. It's a better loan. Now with VA loans, you're actually able to do 100% financing when purchasing a property. So, a lot of veterans, will use that program. They have a chance to, not put, let's say they don't have the money, for a large down payment or whatever. They could do 100% financing and only pay the closing costs. So they have those opportunities, which is used to their advantage, which they like, and that's really it. I mean, right now, like I said, the market is extremely hot. Refinances, rates are low. Everyone's moving out of this. Tory's low for purchases, but it's a great time right now, especially with the rates being low. You can qualify for more. Yeah, I mean, listen, it's a seller's market, but you have the opportunity to qualify for more with rates being so low. When I got into the mortgage business, like, I don't know, 2.5, 3 years ago, rates were at mid 4s and they were climbing into the 5s. I was able to give somebody a 6% rate, in a purchase, which is ridiculous. Now, being that they're so low, clients are happy in regards to, lowering their mortgage payments, qualifying for more, so it's been very good. So, anybody that is looking, that's looking to purchase, it's a good time in regards to getting a good deal on the mortgage. And, people on the fence to refinance, it's a good time to jump on it now. You never know what's going to happen with the election. They say that the rates are going to stay low, but you don't know that. So if you're on the fence, rates are not going to get better than this. They're not going to go to under 2%. They're not going to go to 0%. Where, you see some rumors of things like that. It's not going to happen. The only thing is they're only going to go up from here. The rates this is the lowest they've ever been. So, anybody that's on the fence in regards to wanting to do something, now's the time to do it.